Okay, well, good evening for the people in Europe and good morning for the other people. We have an interesting panel today where our firm professionals, in particular Domenico Sanicandro in Milan and Ilaria Di Tonti in London, at our Italian desk in London, are sharing some experience with me that I am in charge of the international estate planning for the firm overlooking the Italian side. First of all, everybody attending this webinar already knows our firm, so I will be very fast on the presentation. And there is an interesting session of international lawyers or wealth planners at International Bank. So the idea of this webinar has been to talk about Italy, because everybody knows, and we will not dedicate a lot of time on explaining what is it and how the condition to attend the new tax resident regime or the Italian flat tax regime, because we understand that everybody already read some papers. So we will go a little bit further, a little bit deeper, and share some experience. Our first case was in 2017, just a few weeks after the new law. We were among the first firm, among the first movers on this project. And the agenda today is going to be about immigration and relocation, as we have people attending from Latin America and other countries out of Europe. We will dedicate a very quick session to the investor visa, which is actually the fast track to have a Schengen visa and therefore enter Italy and therefore make application for the new tax resident regime that from now on I will say NTR. Then we will have some consideration about estate planning from the right perspective, and we will further move on the need to involve local professionals like many of you, or local banks, international, I mean, local for the perspective of the people moving to Italy. And we will indulge in some, I believe, interesting items about income, inheritance, and gift, in particular, relation with the dual tax application, the treaties application for Italy, because our experience said it to us that there are some specific best practice which is better to know. Then we will move to strategic planning in order to achieve the tax residence. So how long does it take and what is the best practice? And therefore, we will move on 3 separate cases, which gives us the idea to share with you some experience and some do's and don'ts. Okay, so if we can move to the next slide, Ilaria. It's very important and very relevant to remind everybody that the NTR regime has been designed by the Italian Parliament on the specific purpose to attract to Italy those people who would not ever imagine to move to Italy without this law. So it has been made properly to attract ultra high net worth individuals, and it has been a joint effort of the so far left-wing government, but through the various 5, if I'm not wrong, Italian government in Italy. It has never been changed. There are no rumors to change. We will see later numbers on how many applications we had so far. But what is very relevant for me is that we have to take into consideration that moving to Italy is not only a tax move, because life matters. And in this case, we have to consider that if we target separate clusters like bankers or private equity partner, we will have a case later with Domenico. There is the new investment management exemption rule applicable since January 2024, which could be quite interesting for independent fund manager to relocate to Italy. But I will leave to Domenico in his case. It's quite interesting for people, what we call global families, holding investment in several non-Italian companies and real estate and trophy assets worldwide. it's quite interesting also to indulge a little bit about the proportion within a business family, where only a couple of members perhaps they can make application of the NTR regime. But so far, moving to Italy, you can have some advantages also for the other member which are under ordinary regime. We will discuss later about inheritance tax in Italy. And of course, last but not least, it's quite important to understand that Italy legislation toward trust is very friendly. And I say, finally, legislation, because not only we have trust embedded in our direct tax legislation, but the new government guidelines are now inserting in the inheritance tax consolidated tax book actually the trust itself, and the combination between trust and the NTR regime is going to make some interesting best practice that we will have the chance to discuss later on. So if I can move on now with the slide, these are the numbers in reality. As you can see, in 2017, 78 main applicants, 98 people so far. Then 2018, 2019, 2020, 2021. The official numbers in 2029 is 1339. And the question that you may have is, where are the numbers for 2022? Well, number for 2022, we are not yet the official date, because this is the official, because it's coming from the statistics office. It's going to be almost double. So, so far, the COVID effect basically slowed a little bit, but actually, if we compare only our firm, in the last year, we had let's say at minimum double of the numbers of the previous year. So we would expect that 2022 and 2023, which could last very recently, will be soon delivered. As you can see, in terms of money in to Italy is not a high number. So this is something which is relevant in my opinion. I mean, there is still a lot of room for foreign Italian people worldwide to relocate to Italy. But on the same side, it is important to consider the ratio of these NTR rules, which are to attract people that would not have dreamed to become Italian tax residents because without this law, because it was too complex. This law has one of the main pro is that it's quite simple in principle, although, as we will see during today, in this short event, there are a lot of small complexity, because notwithstanding it's a beautiful law, we are still in Italy. And when you are in Italy, you need to provide the client with some basic protections in terms of rule of law and in terms of practical activities. But we will discuss later this, and I now am happy to pass the baton to my fellow colleague Domenico, who's a lawyer in Milan. Domenico.
Thank you, Luigi, and thank you to everyone for attending today our meeting and for sharing your time with us this afternoon. We are going to talk about some legal arrangement that was very, very important for people that would like to move to Italy. In particular, we are going to touch two different areas. The first is linked to immigration and relocation rules relevant in Italy, and the second one is from the tax standpoint. Let me start from the immigration and relocation point of view, because you know it's common in every company, in every country, that people without, in particular in EU, non-EU passport holder can enter in the EU country only as tourists. So they can spend not more than 90 days in 6 months. This means that people would like to establish their residence or stay in Italy permanently. They need to collect a proper visa. In general, in order to collect the visa, it's necessary to spend around 1 year, 1.5 years. But in the 2017, Italian government introduced a very important new institute that is the Golden Visa, the so-called Golden Visa, that is in particular an investor visa. These visas allow to people, no EU passport holder, to move to Italy and to collect not only the visa, the investor visa, but also to collect the resident permit. This is a very important legal arrangement because it's very clear, the rules is very clear, and the procedure is incredible. It's only online, it's not complex to complete. Just to give you a general information on this, the procedure requires around no more than 3-4 months for completing and for collecting the resident permit. And this is, of course, very, very relevant because, in general, you need to spend, as I already told, minimum 1 year. Regarding the investment required by the rules, there are 4 types of investments. 2 million, as you can see in the slide, 2 million in Italian government bonds, 500,000 in equity instruments, share capital, for example, in the company resident in Italy, 250,000 in the share capital of innovative startup, or 1 million in the philanthropic project. Let me say, to be honest, 99% of our clients chose to invest 500,000 in equity instrument. In particular, they chose to invest in Italian listed company. Italian listed company means company listed at Milan stock market, of course. This is for very simple reason in terms of risk of investment. The investing in an insurance company is very low risk. Let me say low risk, but of course the risk in that investment is. But there are another trend that we can see in the last month, that are the investing in the innovative startup company. It means that in terms of investment is down to 250,000, but of course it could be more risky. But this is the feeling of the investor that would like to choose his investment. Another important topic of this investor visa is that the permit holder is not subject to a minimum period of stay, because we need to think about that the investor visa is valid for 2 years and you can renew it for 3 years. And the renewable of the investor visas, you can renew it without any limits. So 3 years and 3 years and 3 years and more. And but at the same time, we have to remember that investor visa is, let me say, a personal document. So you cannot cover your family member. In this case, the classic situation is that one of the family member apply for the investor visa, and the other family member are covered from the family reunion application. That is very common, and due to the fact that this is linked with the investor visa, receive it's not proper special treatment, but they have a more confident on moving to the procedure that could be some important in terms of time. In addition to the investor visa, we have other possibility of visa, other type of visa that are allowed to these people. The elective residence visa, it's one of them. The residence visa is addressed to people that cannot work in Italy. So people that have the financial capacity to live in Italy without working. And it's very important because to underline that this visa, it's outside the entry quota limits that are stated every year in a dedicated degree that are published in general at the end of the year, the 1st of January. Regarding the family reunion, we had already talking about this. Of course, this is very common from people that moving with entire family that decided to transfer to Italy with entire family. Only one member apply for the investor visa and the other member moving through the family reunification. Other, of course, visa are available. In particular, most common is the working visa. So people that starting a work in Italy, this is called the D visa. And of course, this kind of visa is entire in the entry quota limit. So every year we need to check properly not only the requirements, but we need to check how many, let me say, chairs are available for the people, and then there are the limits for people coming from different countries. This is the framework regarding the immigration and relocation law. Let's move to the tax standpoint. Of course, the new tax resident regime, of course, is the most important regime that is stated in the 2017, and this is in connection, of course, with the investor visa. The provision is very, probably is one of the most simplest provision in the Italian tax code, because in order to apply for the regime, there is only one rule. The rule is very simple. The individual must not be resident in Italy for the 9 out of 10 years before he's moving to Italy. So it's very simple to check. We need only to check the tax residence of the individual, and in accordance with not only the Italian rules, but also with the international rule, the tax treaty rules that states regarding the tax residence of individual, we can check properly if the individual is entitled to apply for the regime. Regarding the tax treatment, the proper tax treatment of the regime, it's very simple, because all foreign income are exempt from any other additional taxation in Italy. The only exception is for the capital gain realized for disposal of qualified holdings in the first 5 years. But this is an anti-avoidance rules, that these rules are, it's addressed to avoid that people with enormous capital gains would apply for the new tax residence only for benefiting of the capital gain exemption. So this is a general anti-avoidance rule. And of course, the Italian source income are taxed as and subjected to the ordinary rules. The same is for the inheritance and gift tax, because all rights and all assets abroad are covering by the substitute taxation. That is for 100,000 euro for the main applicant, 25 euros for the year, of course, for the family member. The regime is valid up to 15 years, and it's not possible to opt in and opt out. Once you moving out, the regime is ending. Very important on regarding the family member regime. We'd like to underline that as a family member is very broad. So as we used to talk about your client, pay attention that also your mother-in-law would move with you and your family in Italy. So this is just a little tricky to avoid. And of course, another very important point to underline is regarding the remittance, because the new tax resident regime does not contemplate any remittance rules. This means that you can transfer all your money held abroad in Italy without any tax consequences, without any payment of tax. You are free to move your money from abroad to Italy. I think that it's clear. So
yes.
this is the main point of the.
Thank you, Domenico. So as we were saying, we will not enter too much into the rules that everybody knows. There are basically 4 principles. in order to enter, there is a rule 9 out of 10 years. So this, we will go further with our colleague Ilaria on the scrutiny. But then once you have achieved your NTR position, is basically you split your work within what is in Italy and what is outside of Italy. What is in Italy, you pay ordinary taxes. What is outside of Italy, it's included in the 100,000 K or 25K flat tax. So moving to Ilaria, now Ilaria, you will a little bit indulge on some not so popular comments about what we call be aware, because after so many rulings, we know how the tax authority would react, and in principle, if you can give us some tip and tops to our friends.
Yes, just to come back to what Domenico said before, that the NTR regime is actually one of the simplest rules that we have in Italy. On the other end, there are some practical aspects that we have fine-tuned over the years, because we and the applicants, of course, must take into account some cross-border and international perspective. So in this stage of the webinar, we will discuss about what is advisable to do in the country of departure, and what is the connection between the NTR and the treaty networks, both for direct and indirect taxes. So coming back to the very first moment when the taxpayer and his family decide to move to Italy and apply for the NTR, it is very important to ensure the full compliance in the country of departure, whatever it may be, considering the very specific domestic legislation of each country. So what we normally advise is to be assisted by a professional in the country of origin, but also we normally liaise also with family office, personal assistants, and banks to ensure that we collect all the relevant information, both from the Italian side and the foreign side, to properly draft the ruling that we will file to Italian tax authorities, and where we reconstruct all the tax story of the applicant and their family in the past 9 out of 10 years. This is important because, of course, nowadays with the exchange of information level that is active throughout almost the entire world, the tax authorities of all countries, especially European countries, do know what is relevant for every applicant. Another aspect, which is very relevant, of course, is that residence in the country of departure is actually lost by the taxpayer. This is, of course, very relevant for the case of the UK, let's say, that has a legislation which is completely different to the rules determining the residence of individuals in Italy, let's say. Let's take, for instance, the role of the partner, either spouse or civil partner. In Italy, where the partner is located is very important, and it's sufficient to attract or not to attract the tax resident of the taxpayer in Italy, while in the UK the same index does not have the same relevance. So this is just an example to stress the idea that there must be a coordination between the exit from a country and the entrance to Italy. And of course, this is leads to the filing and the submission of the correct tax returns in every country. So coming back to the ruling, of course, as Domenico said, according to Italian tax law and Article 24 bis, it is not mandatory to file a ruling to Italian tax authorities and obtain a positive response before applying to the anti-R regime. Nonetheless, it is the most advisable thing a taxpayer must do, because of the extent and the importance of such a tax move. So we have, in our experience as a firm, all the taxpayers that we have assisted have filed rulings to Italian tax authorities, and according to our experience, we can now stress the fact that there are three types of three categories of applicants, and this is a, like, let's say, unofficial informal classification from Italian tax authorities, and according to these three categories, there is a different level of information and evidence needed, and also of attention that must be paid while drafting the ruling and while providing tax authorities with documentation. So basically, the easiest category is represented by non-Italian nationals who arrive in Italy and have no ties with Italy in the past, out of 10 years, but maybe in their entire life. So let's take a British family or an Israeli family that wants to relocate to Italy for the first time, and they had no property in Italy, no investment in Italy, no income whatsoever with Italy. This, I mean, of course, the same level of attention is, of course, required from a professional perspective to provide Italian tax authorities with all the relevant information. But let's say that their scrutiny will be less specific than the other two categories. There are Italian nationals who relocate from non-blacklist countries, let's say the UK or the US or another European countries, or Italian national relocating from blacklist countries. This third category, of course, is the most scrutinized by Italian tax authorities, and they will require an increased amount of evidence. Let's say if for people relocating from the so-called whitelist countries, they would require maybe utility bills demonstrating that they were living abroad, and let's say it is sufficient, a sample of 3 months of utility bills out of 1 year. With Italian national relocating from blacklist countries, the level of documentation will cover every month of every year of residence in a blacklist countries. So this is just to say that they will inquire more, and this is linked to the fact that the Italian tax residence of individual from blacklist country is there's a burden of there's a reverse burden of proof on the individual according to Italian tax law Article 2, and this is why there's much scrutiny on these cases. So as we are writing in a slide, a tailored approach to the case must be adopted to ensure that the procedure is successful. As we will also later on see, the Italian tax authorities can inquire further after the first response to the ruling. And so there could be an increased level of scrutiny also at the second stage after the first response to the ruling. So going to the treaty network, there are some aspects that we would like to discuss, with reference to direct taxation and especially to indirect taxation. There's an aspect of the Article 24 bis that provides the possibility to exclude one or more jurisdiction from the option of the anti-error regime. When Domenico described the rule, of course, we didn't mention this aspect, but it is important while talking about the treaty network, because this option is not widely used, because normally applicant will want to pay 100,000 euros and have all their incomes in every jurisdiction covered by the flat tax, but the law grants the possibility to exclude one or more of this jurisdiction from the option. And in this way, this specific income is taxed at ordinary tax rates in Italy as an ordinary taxpayer, and the double tax treaty, if it is enforced with this specific jurisdiction, will apply, and the foreign tax credit can be claimed. As I said, we actually never use it in the practice, but it is worth mentioning it, because the law specifically provides for this option. Another important remark that comes from our experience is that Italian tax authorities do recognize the tax treaty, but just during the time the anti-error is actually applied, so not at the time of the entrance of the taxpayer to Italy. This means that if in the other country a certificate of residence is required, of course, the ordinary rules apply. Normally for ordinary taxpayers, a certificate of residence is issued by Italian tax authorities just after the first tax return is filed, and normally at least after the first tax payment is actually paid. And this is true also for the anti-error taxpayers. So let's say that for a taxpayer that acquires tax resident in Italy in 2024 and pays the flat tax for the first time in 2025, then just after the payment of the flat tax, is it possible to obtain a certificate of residence by Italian tax authorities? And so this is really important, because normally what foreign correspondents and foreign professionals ask is to obtain a certificate of residence that in Italy is not easy. It cannot be easily obtained if not after the first payment tax. So another important aspect is that regarding indirect taxes, because normally when we always talk about relocation and this kind of special regimes that are now widely common in Europe, they only cover direct taxes. But of course, succession planning and inheritance and gift taxes are a very popular topic, especially now, and especially in the UK, where inheritance tax are quite a burden for all the resident and domiciled people. And while in Italy, they can still enjoy a tax rate which is which is amongst the lowest in Europe. Of course, for a new tax residence taxpayer, there's the provision that shields IHT and gift tax in Italy if the taxpayer is an anti-error. So the anti-error applicant will have no issues of inheritance and gift tax, but let's say, for instance, that their relatives who don't apply with him to the regime and who do not pay the 25,000 euros, they could remain exposed to inheritance and gift tax if they move to Italy and if they relocate to Italy and acquire tax residence there. Italy has, and this is why it is important to check if the country of departure has an inheritance and gift tax treaty in force with Italy. As you can see from the slide, there are not many countries that have treaties in force with Italy. And I must add that it's the same with the UK, who has just 5 or 6 tax treaties in force for indirect taxes. All these treaties, not all of them are based on the OECD model, especially the one with the UK, which has been signed in 1968, and the one with France. The highlight is that it covers also the gift tax and not just the inheritance tax. Of course, while applying all this treaty, attention must be paid to the scope and to the rule that determined the application of the treaty. So, because most of treaties relies on the concept of residence domiciled, like the treaty with the UK, of also just with nationality, as it is for Greece. So basically, coming back to our example, the relatives of an NTR taxpayer who relocate to Italy but without the protection of the NTR regime could rely on inheritance tax treaty. Imagining the case of a family relocating to Italy from the UK, the children, let's say, can rely on the treaty as it is now, and so to avoid the taxation, the UK taxation on their asset outside the UK, because of course the UK situs asset will remain subject to UK inheritance tax. So just to conclude, because I think we exceeded the time, attention must be paid to the estate planning also with reference to indirect taxes. So when a family is planning a move, then also this aspect must be taken into consideration.
Yes, thank you, Ilaria. And then let's move to the other slide, which is about timing, what we, in a way, call strategic planning. It's quite relevant because a lot of questions come still today, a couple. First of all, the deadline for the payment of the flat tax is within June the 30th of the year after, meaning that in Italy, we follow the calendar year. So, in example, if you move in November 2024, you will not be treated as tax resident in Italy if you've never been in Italy before, if you don't have your domicile in Italy and so on. You will become Italian tax resident from January the 1st. This is applicable for direct taxation only and not for indirect taxation, because indirect taxation in Italy would follow the civil law concept. So once the family is in example, in November, you will be treated as tax resident for indirect tax purposes, but not for direct tax purposes. And as Ilaria clearly states, if you want a certificate of tax residence, you first have to file your tax return. But in Italy, you have to file electronically your tax return. So it means you have to wait a certain window and to pay in June of the year after. So, I mean, for year 2024, you will pay in June 2025. The second very relevant and important item for timing is that time matters. I mean that if you want to enter the Italian tax environment as an NTR in 2025, it's better you decide now and you move in a while, because it's quite important that if you need an investor visa, we can start with investor visa. Just after a couple of weeks, we can start with NTR ruling. So it will take, as Domenico said, 3-4 months for the investor visa speedy route, if everything goes well and the client provide with all the information. And on the other side, for the NTR, you have to allow technically 4 months. After 4 months, there is what is called, if there is no reply from the tax authority, it means yes, you can enter. But usually they give us a reply and they basically extend the term. So now today, please allow in between 4 and 6 months, even for plain vanilla cases. It's very difficult to go faster, though it's not impossible. We had one experience which basically lasted 11 months because they asked a lot of information. It was an Italian tax resident in a blacklist country, but we will follow up. So in a nutshell, if the client moves to Italy in July 2024, he started the preparation of the ruling in September and submit the ruling in October, meaning that we represent with a power of attorney our firm before the tax authorities, the new taxpayer. So we will send a formal, quite substantial letter and request of ruling, which is basically asking if you, tax authority, consider that all conditions are met and therefore I can become an applicant for NTR. And you allow the first response around 4-6 months later, meaning that you become tax resident in Italy for the full year 2025. And you can have, of course, a full positive answer. Perfect. Otherwise, you can have a request of integration. And in order to avoid decadence, to restart, you have only 365 days to reply the request, which sometimes could be an interesting game to play for very sophisticated cases. If everything is going the proper way, 2025 calendar year in Italy, you are tax resident in Italy, June 2026, you pay 100,000 euro. Be aware always of exit from your country. If it's UK, you have some tests. If you are in Switzerland, if you are in Israel, if you are, depends where you are, there are many attention bell to be considered. But basically, it's quite strategic to plan wisely your move, your relocation move. Okay, so if we can now move to the case studies, I would like to before the slide before, please, the case studies. We have considered quite easy and simple case studies, but just to tell you about our experience. So it's gonna be very, very fast, 5 minutes per cases. We will not go so detailed, but we give you the best practice and basically the idea who supported and the experience that we can exchange with you. Well, the first case is about what we call the classical global family. So now, Ilaria, if you can move on. So let's imagine Mr. Ultra high net worth individual with SPV for yacht, SPV for real estate and trophy asset, personal pleasure assets, a couple of trust companies where is investment, commercial real estate, or even bankable assets. And what is quite relevant, we have to map the family, and we have to map where the income and inheritance and gift flows happens. And it really, it's an interesting classical international estate planning case. I can talk with you about, very quickly, about 2 stories. One is a European French-speaking guy with a very relevant and complex structure. He was resident in the UK. He moved out like 5 years ago. He went to Monaco, then became Belgian. And as a Belgian tax resident, he came knocking our door, and we mapped all the queries that the tax authority would go. But unfortunately, we had some hints that he was also in Italy. The level of scrutiny of the Italian tax authorities, because he was also an Italian passport because of his grandfather, was very high. And basically, we had to fight in a way, in a good manner and full compliance for 9 months to explain the tax authority that it was true that he was living in Monaco. Because, you know, Monaco is blacklisted for Italy. Therefore, notwithstanding his country from where he was relocating was a white list like Belgium, and before was in UK, the fact that a few years he was in Monaco, we had a high level of scrutiny. Another case of scrutiny quite relevant was for another European guy with a villa in Costa Smeralda in Sardinia. And the tax authority came to us saying, look, we have some difficulties, because the good thing is that after so many cases, many firms in Italy, we can talk with the tax authority about these cases. And the ruling is actually aimed to help us and the new taxpayer to enter smoothly, so we can exchange views. But they say, look, these guys cannot enter because he's living in Sardinia. He didn't give you a full picture. Say why, and they provide us with utility bills of Costa Smeralda consortium that, of course, the tax authority in Italy can enter direct some information. One of these are the utility bills. And basically, it was full steam for utility during October, November, December, January, February. So we were a little bit outplaced. We talked with the guy, said, yes, I told you that I have an important place and I like arts. Contemporary arts needs to be warm even in the winter time. So eventually, to make the long story short, we had a video with an iPhone of the villa, and I personally showed the video to the tax authorities, and I did not exchange because, of course, there was some privacy, and they realized that actually the temperature there was for the art, the piece of the art pieces, and not because he was living there. Notwithstanding that, they asked us 10 years of utility bill in Geneva where he was actually living. And after this, actually after 6 months, we let this new taxpayer to enter Italy. So just to give you, it's very relevant that the Italian tax authority, they don't really are interested as us, as an advisor, you on your country, we in Italy, about the whole international estate planning, but they want to be sure that there is no fake moves. So the level of scrutiny is quite high, and of course the tax authority, they don't have access to all this information, because one of the good things of Italy is that we don't exchange with the tax authority the international wealth structuring of the client. Case B is interesting and it's relating to trust. Perhaps you know that trusts in Italy are very well known because we, more than 35 years ago, we signed the Hague Convention. And also in our firm, we have a department working only with trustees and with institutional trust and client using trust worldwide. What is very relevant is the combination between the NTR and the trust rules. Because just like in this easy example, if the people willing to relocate to Italy set up a trust which for Italy is designed with intrusive powers, as the tax authority says. So it means that it is legally a trust, so it's not sham trust, so it's in full legal compliance. But tax-wise, because of the Italian rules about trust, where perhaps not everybody of you knows that in Italy, the trust itself, tax-wise, is an entity. So the taxpayer is the trust, is not transparent, it's opaque as a trust, direct taxation. In this case, we can shape the trust in a way that it works very, very well for CRS purposes, privacy, and also for actually succession planning, because it's in full power. but the tax authority recognized the trust as non-existent. So when the settler entered Italy and paid 100,000 euro lump sum, becoming an NTR, all flows coming out of the trust are included in the flat tax, and therefore you can work quite easily in a way putting asymmetry in between his property in his personal ownership and the properties in the trust, being non-Italian portfolio, non-Italian real estate, participation on companies, and so on. So these, we were among the first firms to design and to discuss with the tax authority this opportunity, but now is very well established, and the tax authority do understand when international ultra high net worth individual moves to Italy with a trust. We actually explain them quite detailed information without having to say too much about the underlying ownership. Another, and I go quick in order to allow then Domenico to make his example. Another case with trust is not related necessarily to the new tax resident. In this case, the settler did not move to Italy, so it's a foreign non-resident in Italy with a trust, very well established trust and very well managed, but the beneficiaries, they moved to Italy. So the fact that the Italian new tax resident paying or not paying 100,000 K, and I go where Ilaria was about inheritance tax, because of the treaty, it works quite well. Because this guy, let's imagine that the beneficiary move out from the UK and become an ordinary resident in Italy. Then the treaty is gonna treat him, the treaty is gonna treat him as an Italian taxpayer, and therefore all assets are out of UK are not anymore taxed by UK inheritance tax. Similarly, the trust treatment in the UK is different, because in Italy now we have a very clear position of the tax authorities since October 2 years ago, and now those guidelines are going to be incorporated in our inheritance tax law, the new tax reform, and therefore in Italy the position of the beneficiary of an international trust is quite convenient, and to achieve full compliance is very easy. And if you do properly work, now we don't have the time to enter into this, but if you work properly, basically the result is that the attribution from the trust, international trust, to the beneficiary can be addressed as a capital income without any taxation, actually, for the new Italian tax resident. So once again, there are several cases here, and I must say that when there is some complexity, more and more NTR are considering to structure a trust in order to better regulate their estate plan. Domenico, I leave to you and to the final cluster of
Yes, okay, thank you, Luigi. Only 2 words on this case, and this was very, very clear, the picture that we are seeing. We assist a manager of a private equity resident in the UK that moved to Italy applying for the new tax resident regime. The point was the tax treatment of the carried interest arising from the fund that this manager with other managers managed. Because, you know, in Italy, the tax treatment of the carried interest is considered as a capital, as a financial gains. So the point, it was main relevant to the concern of the tax authority we discussed was if such income was qualified under Italian law as a carried interest, so as a financial interest in the vehicle, in the fund, and so in this case would be covered by the new tax resident regime, because the funds were one in US and another one in Luxembourg, if I remember well. All the carried interest would be considered as employment income. So in this case, the main point was to liaise very strictly with the tax authorities in order to explain the complex calculation method in order to calculate the carried interest, and in order to demonstrate that the carried interest arising not for the employment agreement between the private equity manager and the fund, but also it was relevant, it was linked to the relevant financial results of the fund. In this case, so this case is shown very well, as you previously said, that is very relevant and crucial to working strictly with the tax authority in order to correctly explain the case, and to working on the agreement, on the situation, and in order to give a clear picture to the tax authorities.
Very well, Domenico. So, in order to conclude, Ilaria, if we can switch, basically, of course, we were talking only about some experience because it's very useful to go case by case in our group of professionals. We are actually working with several jurisdictions, from Africa to Latin to North America to everywhere, actually, to Asia, and of course with Europe. If I may, as a conclusion, there is not a regime which is better or another one. There is the right regime for your case. And Italy in this situation is quite interesting because what we do usually when we are asked by foreign correspondents, friends, and international banks and private clients, we work around the domestic income and gains, tax-wise, I mean, the foreign income, the passive income, the active income, the disclosure and reporting requirement, how the regime works with trust, foundations, holdings, SPVs, shell companies, how it works for gift inheritance tax, what about immigration, what about application of dual tax treaty. And actually, if you compare Italy with Portugal, with Spain, with Switzerland, with UK, where UK will go, they will, our British friends, they will tell us after general election, I believe. So the UK non-dom, and if you look at Europe, there are not so many alternatives. There are some alternatives attracting brains, like the Beckham rule in Spain or new rules in Portugal. Even in Italy, we have a very good rule about this. But something like the new tax resident regime, really you have to compare it with Monaco. And just to conclude, we have an experience also about people moving, relocating out from Monaco, becoming Italian new tax resident, because of course they pay 100,000 K, but last but not least, there is not the need to stay, you know, with utility bills open to demonstrate that you live in one country. Italy is a G7, G20 country, and we are actually a beautiful place, not only for tax. And again, it is very important to combine life and to balance the needs of the whole families. And what we see in Italy is people coming sometime directly to Milan, other time directly to Venice, directly to Puglia, in the Italian island. It's really a lot of different experience. And I must say, we're very proud that we can serve such beautiful people. And we do hope that this regime, we trust that this regime will last, because it's actually starting to giving back the benefit to the Italian authorities, not only in direct taxation, but in private spending into Italy, which, I wish you will come to Milan soon, you will notice when you walk around now the level of English is not only touristic people, there is a lot of people in Milan, in Venice, in Bologna, and in other Italian business places where you start feeling the international dwellers. Well, thank you very much. As said, we were no more than 1 hour. We are happy to share these slides with you. It will be provided by our organization. And I thank everybody for the level of attention. And of course, the webinar are very monophase, but one-to-one, we can follow up this meeting. Thank you very much. Good evening, and cheerio to everybody. Bye-bye.
Thank you.
Thank you, bye.